Central banks have been extremely active over the past few years. QE, zero interest rate policy, all to get economies back on track following the financial crisis. But what has this manipulation meant for financial markets in the long run? With me now is James Bevan from CCLA to discuss whether Adam Smith's invisible hand does indeed need directing. James, has all this central bank influence warped value calculations in global markets?
Oh, most certainly. Because after all, if one thinks about the perspective, the valuation of all investments, there is a hierarchy of risk and return, all keyed off the so-called risk-free rate of return that is, of course, ultimately driven by central bank policy.
Well, much of the slowdown has, of course, been linked to the usual culprits. We've got China, we've got oil prices. How much have central banks added to the mix?
Well, I think that central banks have done a good deal to solve the problem, and rather more than perhaps they should. And therefore, I think that it was entirely appropriate that they allowed credit to be available, they sorted out the commercial banking sector, they provided a climate of low interest rates that made debt sustainable. I do think, however, that there are aspects of quantitative easing and therefore the mispricing of securities that are deeply troubling, and I think negative interest rates are immensely corrosive for the financial system, not just the banks, but also for consumers.
The Fed, for instance, follows economic data rather than markets. What do you think are the issues with this?
Well, I think it's rather interesting. The Fed likes to tell us it follows economic data, but I would observe, in terms of the policy statements and actions, the Fed is really rather interested in markets. So, for example, in December, they said, look, guys, the economy's fine. Get ready for 4 more hikes in 2016. Actually, the US economy has not been derailed. Markets are well down, and now the Fed is making statements about, actually, maybe we've been a bit hasty, maybe we won't be hiking as much. So all the evidence says that actually central banks are extremely market aware rather than economy aware. The second point I would make is that central banks talk about inflation, and yet they really think about 18 months in advance. And therefore, I suspect the Federal Reserve might be prepared to let inflation run so long as wage inflation remains low.
Finally, do you think policymakers pay enough attention to financial markets to gauge economic performance moving forwards?
I worry that policymakers are largely not coordinated. And so central bankers look at an agenda of trying to get growth going, trying to get inflation going, depending on their mandate. But they do not work in concert with governments that set fiscal policy or regulators and authorities that provide the framework in which companies and individuals will operate. And until we get a more cohesive approach to overall economic policy, I do worry that we will not be able to achieve real traction for global growth.